Good afternoon, everyone. Welcome to Offices Adda 24/7. My name is Niharika Walia Bhatnagar, and today I am here with you for JAIIB. Okay, I hope the last session was helpful for you. This is the third session in a row that I'm taking, which are of various specific areas for the JAIIB. The first session that I took in this week was related to Module C. The second session that I took was related to the entire Mahamarathon, which is of a good number of hours, covering the area of practical questions, numerical questions, conceptual questions, tedious questions, as well as simple ones. So it's going to be a cluster of lot of things. Yesterday it was the same, and today I'm going to continue further, and I will be taking up the JAIIB mini marathon on the Module C portion as well as Module D portion that we were covering up in the last session. So first of all, my focus is going to be on the Module C first, and then we'll be moving on towards Module D. Okay, before we continue further, please let me know if I'm clearly audible as well as visible. Secondly, if you like this particular session, please go ahead and click on the like button. And at the same time, if you haven't subscribed to our channel yet, go ahead and subscribe it. Along with this, we are coming up with our JAIIB PPB Mahamarathon today. That would be taken up by Amanjot ma'am. So kindly be there in that particular session as well. Till then, if you're here, please share the session, like the session, as well as let's move on today. Okay. What are we going to talk about today? As I told you, today's session is going to be exclusively of Module C and D. In the last session, yes, we were talking about one more thing, that was the conceptual areas, golden rules of accounting. I have covered a part of golden rules of accounting in the morning session as well. So I think if you have missed out or you haven't seen it yet, in the morning session, I'd covered a part of it. Then in today's session, I'll be going further. Everybody who's a part of the paid batches as well, we are also covering all these things here as well. Acha everyone, a reminder, everything has been now shared on the Telegram channel as well. I have shared Module A. So once you have received that particular area, kindly just acknowledge that part. Let me know that you are there in the Telegram channel, and then I'll be forwarding the remaining ones as well as the questions of this JAIIB mini marathon as well. So this is the mini marathon area that we are discussing today. So that is a portion that I'll be talking about. Let's talk about it. Good afternoon, everyone. Please join in and please keep on sharing the session. I think I received a lot of appreciation from you guys yesterday as well. So I would love to see the same level of enthusiasm and energy today as well. And I think that's absolutely right when we come to know about the AFM examination this year. So everybody, let's go ahead. The first question, it talks about CSR. Corporate social responsibility, something which was introduced in 2013 Act, which they said ki, pata, this is now mandatory for many companies. This is not something that you are doing it as a charity. The government has made sure that you are putting specific amount of money separately, right? What is the question, everyone? Which of the following statements about the corporate social responsibility is not correct? In this case, the first question says that the Companies Act 2013 specifies the companies which are required to spend the money on CSR. Then the second point says that the CSR spent is totally voluntary and there is no legal requirement. Is that so? Right? Then comes the next point, that is only specified activities are eligible to be covered under CSR. Yes, that is true. Companies are required to spend at least 2% of their average net profits of the CSR. Acha, one thing is true, that this is something which is CSR is totally voluntary. That's not the case. CSR is something which is mandatory in many cases as well. It is basically something which we specify that certain organizations have to do that. No problem, ma'am. Please join in, everyone. Okay, so in this case, what we're talking about is CSR is mandatory for many organizations. It is not something optional for everybody. Okay? So in this case, the correct answer is CSR is totally voluntary. That's absolutely wrong. It is your choice if you want to do it, but the department has definitely made sure that there are certain organizations which are supposed to keep 2% of their turnover for this purpose. Rajiv sir, Masood sir, have you seen the particular PDF in the Telegram channel as well? I hope you've received that. I'll be sharing the remaining today only. Now comes the next question, everyone. Which one of the following can be considered as the agency problem in financial management? When the financial management came, there was one major problem which was occurring in the specific area. That was shareholders are the owners of the money. If this is my money, I'll be spending it very wisely. But if it is someone else's money, I can be wise, but up to what extent? Something which doesn't belong to me will not bother me that much, isn't it? This is something which happened in the agency as well. Agency problem was related to the conflict of interest between the company and the suppliers, conflict of interest between the company and its customers, conflict of interest between the company and the government, conflict of interest between the shareholders and the management of the company. So in this case, what would be the answer? Which one of the following can be considered as an agency problem? Agency is something where management acts as the agent of the shareholders. So what would be the answer in this case, everyone? Conflict of interest between the company and the suppliers. Is it about the suppliers or the customers or the government? I would say all of these are something which will not be affecting the organization at all. Will they? They are external parties. Internal parties, there are only one, that is management. So shareholder and management, when they are having any problems, it would be covered here. Okay, that is conflict of interest between the two parties. Next point. This is the problem of agency, everyone. A conflict of interest inherent in any relationship where the party is expected to act in another's best interests. Basically, we have shareholders as well as management. When these two different set of people are trying to work together, what's the problem is? The basic problem that occurs is management feels that there is too much pressure from the shareholder side, and shareholders feel that the management is not working at all. This is not working out well. So that is the conflict between the two. Next point. The capital structure implies which one of the following? It implies that the proportion of fixed and current assets, proportion of current assets and the current liabilities, proportion of long-term and short-term liabilities, and proportion of debt and capital. Capital structure, everyone. There are two things. One thing is called cost of capital, whatever I'm paying as a cost. One is cost of capital. The second one is capital structure. If I borrow some money from you, the percentage that I pay to you is cost of capital. Capital structure can be defined as something which is basically the blend of debt and equity. Please go ahead and keep on sharing the session, everyone. And if it is turning out to be beneficial, go ahead and like it as well. Okay. In terms of capital structure is related to the proportion of fixed and current assets and current liabilities, long-term and short-term liabilities, or debt and capital. Acha, one thing is for sure, it has nothing to do with current and non-current assets. It has nothing to do with liabilities as well. See, the point is when we are trying to have this now, what is the amount that I should bring in? What is the amount that I should take from others? That is, it is a proportion of debt and equity. I can say the capital structure is basically between debt and equity, and under equity we have preference as well as equity shareholders. So both of these, what is the proportion of all of these would be covered in this area. Next point, inventory ratio is the relationship between the cost of goods sold and the cost of average inventory, the cost of goods purchased and cost of average inventory, cost of goods sold and cost of average inventory, and cost of goods last is none of them. Inventory ratio. This is ratio analysis. One of the most important topics which is frequently asked in the examination. That too in the case study format, not in the normal format. This is something which is asked in the case study format even. A very, very important topic, ratios. And this is one of the most important ratios, ITR, inventory turnover ratio. Let's not look at the particular options again. If you know the ratio, then it's way better that you follow the ratio. ITR is basically COGS upon average stock. COGS upon average stock, how can it be explained? In this case, it is cost of goods sold. Sometimes if cost is not given, then we take RFO. RFO is something that is revenue from operations. In sales, in companies now, we write sales as RFO. Okay, so in this case, what would be the answer? Cost of goods sold and the cost of inventory. Then in the third part, it is cost of goods sold and the cost of average inventory and the cost of purchased and the cost of inventory. See, this is something which is unnecessarily elongated. So if I look at the format there, it would be a purchase is already included there. Masood sir? If I say, Acha sir, if I'm saying that inventory, now inventory includes raw material, it includes WIP, it includes finished goods. That means it is covering all those necessary areas that are required. Isn't it? If it is already covering, why to include something there? Yes sir, no problem there. Next point. Acha, this is a question of equity shares. What happens, ratio analysis? Again, this happens in this examination that they can give you such kind of information and they will give you multiple questions. What I have done is I will be giving you separate questions rather than giving one. In this case, we'll be able to cover more of formulas, right? So please go through it and Acha, in case of reviewing, once you are done with all this, whatever I'd be putting, because I am taking a marathon today, I'll be taking a marathon tomorrow as well. Now the mini marathons will be going on. Okay? So what you can do is, along with this, if you also want to review more questions, I had taken a marathon with the new syllabus in May attempt as well. So go through the channel. You can also review those particular set of questions as well, if you are someone who is not a part of Adda there. Because if you are a part of Adda, then if you are a part of our paid students or you are already seeing the videos there, so you will be able to find a lot of questions on the website or in the app, because mock tests are available and everything else is also available. At this point of time, testing is super important, right? But don't go for blind testing. Don't go for it ki chalo let's try ki how much my guess is going correct. That kind of thing should not be happening at this point of time. Focus on the conceptual knowledge and the testing together. Equity share capital 20 lakh, reserves 5 lakh, debentures 10 lakh, current liabilities 8 lakh. Debt equity ratio would be, okay, Dolly ma'am, according to you it is 0.5:1. And ma'am, according to you it is B. Okay, let's find out everyone. Debt is what? Debt is outside party. Okay, everyone, when we talk about debt and when we talk about equity, what do we say in this area? If I talk about debt and equity, it would be basically long-term debt upon equity. And equity doesn't include equity shareholder only. It's just a myth that sometimes people think, it is only equity now. No, it's not. It is actually equity plus preference plus reserves minus any of those fictitious assets, for example, preliminary expenses, and minus trade investments. This is the full-fledged definition of equity, debt upon equity. So in this case, I think a couple of things are given there. In terms of debt, they have given current liabilities as well. This is basically just to confuse you. The debentures are of rupees 10 lakh written. What is the amount of equity there? Equity shares are 20 lakh. Reserves are of 5 lakh. Doesn't it make it 25? Got the point, ma'am? In this case, this is the only issue where people lose marks, because people think that equity means only the equity share capital, but it also includes the area of reserves and surplus. It also includes the different reserves that are there. Fictitious assets has to be reduced. For example, preliminary expenses. So in this case, what would be the answer then? The answer is totally changing. This is how they play with the mind. Chaliye. Next point, what do we look forward to? There it is. The answer is 0.4:1. Next point. Okay. The next point says, on the basis of the following data, debt equity ratio will be. Another question of debt equity ratio. Share capital is 5 lakh. General reserves is 3 lakh 20. Then we are given preliminary expenses of 20,000. This is where the particular concept which I just told you works. And then debentures are also given. Preliminary expenses are again repeated. Now removing this. Debentures are of 3 lakh 20. Current liabilities are also given. In such a question, they will not give you one, but they will look forward towards a lot of this. Okay, now let's move on and talk about it. When we talk about this ratio, it is debt upon equity. In the area of commerce, this particular topic of debt equity is there when we are barely not even 16, 17. So this particular topic is something that probably when I was student only, I think I would have done it 100 to 200 questions when I just started learning the topic of ratios. So when we talk about working at Adda or working as a teacher, one particular thing is definitely there. If we are teaching, then that means if we are teaching this much, we have to work this much. So I would say when it comes to the teaching portion, it requires a lot of hard work and a lot of sleepless nights as well. So when we are preparing for all these things, definitely we keep on going through the area that we are working upon. So even if it's about looking at the notebook, those notes would have been made by me again. Because as a student, even I used to make a lot of notes. And this is what even I tell my bankers as well. Whenever you sit and study, you should be having your own notes, because ultimately you remember what is written by your own hand. My sir used to say, the teacher who told me a lot of things regarding accounting, sir used to say, Niharika, this hand has a memory. Whatever you will write with it now, you will remember in the examination as well. So that's one of the basic things regarding accountancy. It's similar to that area of mathematics. When you write things, you will remember. When you practice it, you will definitely remember. So I know there are many people who are non-commerce background and they might be having problems with it. But the point is, when you practice, you will make through. Narrator, most probably, I think currently I've got good number of questions again. So I think it might go up to 2 hours, but won't be keeping it further, because from 6 a.m. from 6 p.m. you will be having another marathon. So it's going to be a lot of things for you today. So yeah, I'll try to keep it a little easier on you. And yes, I will be sharing all these things together. All the PDFs would be shared in the Telegram channel, pinned with it, so that you have all these particular PDFs with you. Whenever you get time, you can go through it. Along with this, if you have seen, the answers are also given there. So in this case, you will not have to worry about what is happening and what isn't. So you will be able to look at the questions as well as answers. Okay? Chaliye, on the basis of the following data, when we are talking about this, equity is basically of 5 lakhs. Then general reserve is of 3.2 lakhs. Then when we talk about preliminary expenses, it is basically something which I have to remove because this is a fictitious assets. So I would say I will remove the 0.2 lakh. Okay? And debentures is of 3.2. This is 3,20,000. Achha, I'm writing it in a proper manner so that you can actually see the entire calculation, because I think in the answer you won't find the entire calculation there. It is basically the debt is of 3,20,000 divided by the debt is of 3,20,000. Please do not consider the current liabilities. Okay? The current liabilities should not be considered. In this area, equity was of 5 lakh. There is no preference share, so I'm not adding it. Then we have the reserves of rupees 3,20,000. But there is one other problem, that is our preliminary expenses. So remove this 20,000 and get the answer now. Done, everyone? Okay, so let's calculate it together. It comes out to be 8 lakhs, 3,20,000 divided by 8 lakhs. Is it again 0.4:1? Correct, Dolly ma'am. That's a great quick, ma'am. I think we just looked at the previous question, which was similar, and this is the correct answer, 0.4:1. Chaliye, let's look at the next question. This is from the area of ratios again, and this is talking about operating ratio. Acha, there is in operating ratio there are two things. One is cost and one is profit. In this area, I'm talking about operating ratio, which is from the area of operating cost. But what if I don't know the formula of operating profit? It's easier. How? Let's take the total as 100. If the operating cost comes out to be 60%. Everyone, what would be the area of profit then? Even if you don't know the formula, then what will happen? If the cost is defined as 60%, what would be your profit then? If cost is 60, then profit would be 40. Balancing figure, na? So that's how you can calculate the operating profit as well. If you know the formula of operating cost. What's the formula for operating cost? In this area, operating cost means the cost which is running cost for the business. That includes COGS plus your admin expenses plus your selling expenses and divided by RFO. All the ratios here, most of the ratios in this area you will find in this particular area of turnover and all, na, you will find that they have given super duper importance to the sales there. See, 96.33. Okay, let's look at the question. Revenue from operations is given and GP is 20%. In this question, we are missing out on COGS. How do we find the COGS? It is 6 lakhs minus 20%. 6 lakhs minus 20% would be 4,80,000. You know? This is going to be the amount of COGS. Current liabilities are short term, Rajiv sir. That's why we do not include it. All these extra information are just there so that you get confused in the lot of data. Basically, in the ratio analysis, there are two challenges. One is to remember the formula, and secondly is to filter out the most important problems there. We have to make sure that which part of the formula is relevant for us and which is not. Everybody, the details of our Mahapacks is also shared in the content section, and you can review it. And plus, if you haven't liked the section yet, if you like this particular session and it is turning out to be beneficial, then please go ahead and like it and share it. Okay, moving forward, now we're talking about COGS. We have found the COGS now. It is 4,80,000. Then admin expenses, there is no, they have given it in the form of office expenses. Office expenses are admin only. That is 30,000. Plus selling expenses are of 48,000. And divided by what? In this case, we will be dividing it by 6 lakhs. Done? So, can you calculate it? What's the percentage coming up? It turns out to be 93. It is D. Very good, Dolly ma'am. Okay. In this case, the correct answer is 93. Next question. Assuming the liquid ratio is 1.2:1, the cash collected from debtors would be. Acha, liquid ratio is different from liquidity. Yes, it is. Liquidity means if you ask me that, ma'am, do you have money? And I take out money from the pocket and say, yes, I have. This is liquidity. If in a normal day, there is a dire need of money, I should be having that in my pocket. That is liquidity. When we talk about liquid ratio, it says quick assets upon current liabilities. The quick assets removes certain current assets out of it. From all the current assets, inventory takes a hell lot of time to sell. If the inventory would have sold in at any point of time, the organizations wouldn't have been having the bad timings at all. Because the problem is because they get a lot of inventory with them, which is still with them and it is not being sold at all. That creates a lot of fuss and fuss among them. Hai na? So one is inventory and prepaid expenses. If I have paid my landlord the rent for the next 2 months, and if I ask them, can you give me the rent for now? Can you return the amount to me for now? And then I'll pakka give it back to you after maybe 2 months or 3 months. Whatever the month would be, I will pay according to the due amount. It won't work out. Most of the time it won't. Another example, this example can still happen, humans there. If I have paid the recharge of my phone, it is a 3-month recharge. Now October is going on, October, November, December. Can I go to Jio and say, nahi, sir, can you give me the money back for the 2 months and just charge for this month only? Once the money is gone, it's gone. So that means this is based upon time. So this will never come back. In this case, they are saying the cash is collected from debtors. It would increase the current ratio, decrease the liquid ratio, have no effect, or increase the gross profit. What would be the answer? In terms of the quick ratio, how do we specify? In this case, I would have received cash and I would have lost my debtors. In this case, nothing will change. Why? If I received 10,000, my debtor was also of 10,000. Debtor is gone and I received cash. So in this case, the answer will come out to be, it has no effect. Such kind of questions are basically mind-boggling. Why? Because they have nothing to do, but still has a lot of things to think about. Maybe I am going wrong. Maybe the answer might be different. This kind of thing can definitely affect us. Done? Done, everyone? So most probably it would go till 6. I'll try to finish it up before 6 then. Let's see. Next point. The credit revenue from operations and cash revenue from operations is given. Debtors are given. Bills receivables are given. And average collection period will be. Average collection period, in how much time we collect the money. Okay, let's look at this. The credit revenue from operations. This is cash revenue and we are talking about for calculating this average collection period, first of all, you have to calculate TR, trade receivable turnover ratio. How do we calculate the trade receivable turnover ratio? To calculate trade receivable turnover ratio, you have to take credit. Achha, the question is incomplete then. No, it is given. That is credit sales divided by average debtors. As such, in the sophisticated way, we always write it as credit trade receivables divided by average trade receivables. Credit, this is sales, na? This is written as credit revenue from operations divided by average trade receivables, which includes our debtors and our DRs. In this question, since all the things are missing, we have just got 6 lakh rupees and we have got debtors of rupees 1 lakh. Does this mean it comes out to be 6 times? This specific ratio is expressed in times, everyone. This turns out to be 6 times. In an year, we are collecting the money from our debtors 6 times. So after how much time will they be paying us? Divide it by 12 if it is in months. If they require it in days, it is 365, and in terms of weeks, it would be 52 divided by your TR. That would be here, it is 6. So if you divide it by 6, you will get, Rajiv sir, C. Okay. Everybody else, what's the answer? It would be in this case, the correct answer would be 2 months. No, it would be 2. The answer is wrong because credit revenue is of 6 and cash revenue has nothing to do. Oh, I forgot. I made a mistake. It is 1 lakh and this is also 50. So I will have to divide it by 1 lakh 50 because there is a bills receivable as well. So in this case, it has to be. This is the only challenge in terms of ratios that happens. 1 lakh 50, this will come out to be 4 times. And when we divide 12 by 4, it turns out to be 3. The answer would be 3 months. Because I didn't consider the bills receivable. You have to consider both the debtors as well as bills receivable, everyone. Done? It is 3 months. Next point. Working capital is equal to current assets minus current liabilities plus current liabilities divided by current liability or none of the above. Working capital is, everyone, working capital is what? Working capital is CA minus CL. We did a similar question, I think, yesterday, but it was a different concept in which we covered it, right? It is CA minus CL. Okay, next question. Again, trade receivable turnover ratio. Try it out, everyone. Give me the answers. Trade receivable, total revenue is given, cash revenue is given, debtors are given, BR is given, and you have to calculate TR. Total revenue from operations is 9 lakh. Cash is this. Okay, everyone. Hint. If you have to find credit, it is total minus cash. The total are of 9 lakh. The cash revenue from operations is 3 lakhs. In this case, what are we getting? we will get around 6 lakhs. Once we get this 6 lakhs, this is our credit revenue from operations, and we have to take both of these, 1 lakh and 20. We have 6 lakhs divided by 1,20,000. What is the answer then? 7.5? Why 7.5? We have to consider both na, 1 lakh as well as 20. And in this case, we are given cash and total. They didn't provide us the credit. Yes? The answer is 5 times. All the turnover ratios are expressed in times. The answer is 5 times. I've given the solution for this along with the entire calculations as well. So I think whenever I'll be sharing this particular PDF, then you will be able to solve it as well. Next question. It says, which ratio is considered as safe safe margin of solvency? What do you mean by safe margin of solvency, everyone? Safe margin is if I have to pay money to someone, that at that point of time when I have to suddenly pay to them, then even after paying, I should be having something in my pocket. है ना? That would be liquidity ratio, liquid ratio, quick ratio, current ratio, or none. These are all part of liquidity ratio. Liquidity means short-term solvency. That means if suddenly I have to pay to someone, I should be having enough money in my pocket that even after making the payment, I have something further to sustain myself. Right? So in this case, what would be the correct answer? The correct answer would be C, the current ratio. It looks like quick or liquid, but it is actually current ratio. Okay, WCTR. Somehow added more questions of turnover. If possible, in tomorrow's class, I'll add a little more. Of other ratios as well. Okay. Current assets are given, current liabilities are given, revenue from operations are given, and they are asking WCTR. Working capital turnover ratio. What is WCTR? It is RFO divided by CA minus CL. Done? In this case, what would be the answer? RFO is 28 lakhs. Your current assets are of 5 lakh minus 1 lakh. It would be 4 lakh. So what would be the answer in this case? Rajiv sir, A. Anjika ma'am, C. Go ahead and answer, everyone. The correct answer here would be 7 times. 28 divided by 4, it will turn out to be 7 times. Right? Okay, next question. Okay, the next question is regarding revenue from operations is given, and you have to find the value of closing inventory. There you have to use the COGS. Revenue from operations is 2 lakh. Inventory turnover ratio is given. ITR is given to you. ITR is 5. And this kind of question can come up as a case study, where they can ask you multiple things. Done? ITR is 5. Revenue from operations is 2 lakh. And GP is 25% of it. So basically, to find out the COGS, I have to remove 2 lakh minus 25%. That would be the value. It will turn out to be 1,50,000. है ना? It is actually ITR is equal to 1,50,000 and find out the value of closing inventory if the closing inventory is 8,000 more than the opening inventory. That means let the opening be X and closing is X plus 8,000. This would be the formula. First of all, the best thing to do is divide 1,50,000 by 5. This gives you that 30,000 is the average. If we know that this is the average, so let's use it in this case now. We will say that 1,50,000 divided by average stock is equal to 5. So in this case, 1,50,000 divided by 5 is equal to 30,000. So what will we do in this case? 30,000 is the average, which is equal to X plus 8,000 divided by 2. $30,000 is equal to 2x plus 8,000 divided by 2. Now calculate the answer, everyone. What would be the answer in this case? This can come up as a case study answering, calculating multiple things. Opening plus closing divided by 2. In this case, the correct answer will come out to be 34,000. You have to see what we are calculating. Are we calculating the opening stock? Are we calculating the closing stock? And what are the exact points they're looking forward to? This kind of question will not come as single question. This will come as a multiple or a cluster based question. Find this, and find this. So first of all, in this question, they can give you find COGS. Then they can give you the value of the opening stock. Then they can ask you to calculate the closing stock as well. So one particular question with 3 different points. Ratio analysis is known for the case study area. Okay, now here comes the question. This is from interest and annuities. Similar kind of question was asked in the examination as well. The population of an industrial town is increasing by 5% every year. If the present population is 1 million, then estimate the population after 5 years hence, and also estimate the population 3 years ago. Achha, I think in this area, I have asked you only the first part. Since this was a question from the book itself, I have just asked you the first portion. Go ahead and try it. This would be compounding or simple interest. This kind of question is a part of compounding, everyone. This kind of question is a part of compounding. And in terms of compounding, what's the formula? Whatever your principal is, principal 1 plus r raised to power n. So what you have to do is, we are moving on by 5 years now. It is going to be 1 million here. Okay? It is going to be 1 million and 1 plus 5% and raised to power 5. This would be the formula that we'll be using. Acha, can we calculate 1 plus 5% there? Let me share that part with you as well. In the system calculator, how do we do it? If this is the system calculator, how do we add 1 plus 5%? It is basically 1 plus 5%. It gives us 1.05, everyone. Now, you want to calculate 5 times of it. Hai na? You want to find out 1 plus 5% raised to power 5. How do we calculate without even noting down even a single point there? You have to learn how to use the calculators without noting down things, right? So what I'll do is, I will multiply, click on multiply once, and this is clicking on equal to. This is square already. That means if I want it for 5 times, now 3 more times to go. 1, 2, and 3. This gives me 1276815625. And if I look at the question in this area, they have given 1276280. Multiplying it by 1 million, then you will get 1276281. In this case, what did I do? I didn't even press a single button and noted down everything. Ki acha square is going on, then a cube is going on. No, I don't have to do it. Simpler way, repeating it again. If I have given 2 and I want to reach out 2 raised to power 5, how do I reach there? First of all, clicking on multiply. If the power is 5, 1 less than that power, we'll be clicking on equal to. That means I have multiplied on I have clicked on multiplied only once, clicking on equal to 4 times. 1, 2, 3, 4. And here is the answer for 2 raised to power 5. Whenever we are calculating such questions, this is the basic reason that I always say you should be well versed with the calculators that you are using. The similar calculator I have in my phone, but I cannot work in a similar way on my calculator in the phone as I can work on the system. In terms of using specific calculators, I specifically believe that using one specific model that you are practicing every single day, and that is the same calculator you are taking to the examination hall as well. That's one of the best ways if you are preparing for these examinations seriously. Because they are going to give you questions based upon calculation. You should not be just thinking about, okay, I'll do the calculation portion later on. If you know the ways, you will definitely be able to do it. Done, everyone? Please confirm, everyone. Anand sir, Dolly ma'am, Yogesh sir, got the idea? This case, the answer is actually 1276280. This was a case of compounding, moving forward. If I have to go back, I have to discount. Then I will be dividing. I will be dividing the entire amount, whatever 1 million is. If I have to go back, then I will divide 1 million by 1 plus r raised to power 3, because they wanted in the question to go back by 3 years. In terms of compounding, if I use that the amount is now 1 million after principal 1 plus r raised to power n. है ना? So today it is 1 million. The principal, if is not known to you, at least the interest is, you just have to divide. In the next part, I think I'll cover up the area of dividing this as well without noting down as well. Everyone got the idea? Please confirm if you've got the idea of the particular calculator trick. Another question from the IBF book itself. Avichal Publishers buys a machine of rupees 20,000. This is one of the illustrations converted into an MCQ for you. I expect that this year as well they are going to do this. They would be asking questions from the illustrative era and the questions that are within the IBF book. So Avichal Publishers buys a machine for rupees 20,000. The rate of depreciation is 10%. Find the depreciated value. Thank you so much, ma'am. And the machine after 3 years. I know many of you would be sitting in the office as well. You might be doing a lot of things today, but the point is in the evening we have marathons. You have the entire day to study as well. So we had to keep the class at this point of time. If you are there in the class, then please be active, participate. And if this is helpful for you, then please go ahead and write in the comment section about the same as well. I'll be waiting for the replies. Okay, now in this case, we are having 20,000 rupees. Acha, pata, this particular question can be done in both the ways. One way is to look at the question from the depreciation point of view. WDV method, nothing stated, use it. You can also use the interest and annuities method in it. Okay, I'll be doing it with the interest and annuities because depreciation part is something which we are done with already. Avichal Publishers buys a machine for rupees 20,000. The rate of depreciation is 10%. Find the depreciated value of the machine after 3 years. I want to find the depreciated value of the machine that would be after 3 years. That means 1 plus, what is the depreciation percentage? 1 plus 10% raised to power 3. Calculate this point, everyone. Let's calculate it. 1 plus 10% raised to power 3. How would you calculate it in your calculator? Calci points. First, you will have to click on 1, then plus, then 10, then percentage. 1 plus 10% will give you 1.1. Once you see this 1.1 in your calculator, then click on multiply and click on equal to. Since this is 3, the clicking on equal to should be 2. The answer is equal to 1.331 multiplied by 20,000. है ना? Oh, it is cube now. After 3 years, we'll find the depreciated value after 3 years. So this is basically when we are covering this. Nahin, I've taken it wrong. It will not be a plus. It is actually going to be a minus. This is when we are going further. In this question, we will have to go back. That's the mistake. We will have to go back. This was actually a part. Since I was doing the previous question that was related to compounding now, so I did the same thing here. This is actually going back. If I'm doing it using the method of WDV, it would go like 20,000 minus 10% of it. It would be 2,000. Then it turns out to be 18,000 minus 1,800. It is 10% now. Then another 10%. It would come out to be 14,580 in that case as well. We have to use both the methods. We can use actually both the methods. This is what the mistake was. Let me show you this part as well on the calculator. Okay. Now, let's look at the calculator again. Now, I was doing not a plus, but a minus. How do we solve it? 1. Can you see this now? It turns out to be 1 minus 10%. 1 minus 10% will give you what? 0.9. And you need to have the cube of it. Multiply equal to. This comes out as square and this comes as cube. So this is the value. Yes, sir. Either you can use diminishing balance method, or this is also a proof that even if you use the other method, the answer will come out to be the same. This would be your value. You can do all kinds of stuff. Whatever calculation you are using, you can use all kind of calculations in your calculators without noting down anything. The purpose of showing you this was that only, that you understand that you don't have to write down everything. Your calculator can do everything. You just need to know where to click the buttons and then you will find the answer. See, in this case, it would be 0.729. 0.729 multiplied by 20,000. The amount that is left is 14580. Same answer. So that would be 14580. If I have to find the depreciation would be the difference between the two, 5420. Find the amount of depreciation after 3 years. We are done with this. 5420 is the total depreciation that has been charged. Okay, 5420. In the next question, they are asking, what is the average rate of depreciation, everyone? Hari sir, you are absolutely right. We were using diminishing balance method as well. Because if you use the diminishing balance method, the question becomes easier. But this particular question was just to show you the calculation of the conceptual point. Everyone, answer. What is the average rate of depreciation? Average rate will be 5420 divided by 20,000 multiplied by 100. What's the value, everyone? What's the value? In this case, the amount will come out to be 9.033. Done? Okay, next question. If the interest is deducted from the principal amount and only the net amount is disbursed, it is called back-end interest. Then it is called bullet repayment. Then is sinking fund or front-end interest. These wordings are exactly given in the IIBF book. Back-end bullet repayment means the payment which is made instantaneously. And then we have sinking fund. I know the value of things are declining. So why not saving some part of the interest every single day? I'm keeping a part of my interest separate. That is sinking fund. Front-end interest is basically the interest that I am... okay. If I give the answer there, then the point will become very easy. Normally, what we have is back-end interest. In the interest portion, this normally what happens is you disperse the entire amount of loan and then you get the principal plus interest as EMI, while that is called back-end interest. When we talk about front-end interest is if the interest is deducted from the principal amount and only the net amount is given to you. Normally, we do not follow this method. In the banking sector, we follow back-end. Okay? The answer is D, the front-end interest. Okay, next question, capital budgeting. In the term capital budgeting, the term capital rationing implies. What does it mean? That no retained earnings are available, that limited funds are available for investment, then that no external funds can be raised, that no fresh investments is required in current year. What would be the answer? In capital rationing. Capital rationing is basically allocation of funds into two or more different areas. That no retained earnings are available, the limited funds are available for investment, that no external funds are raised, and that no fresh investments is required. This thing doesn't work out that way. It is basically that limited funds are available for investment, and let's put it into different areas altogether. Allocation of fund has to be done in a very smart manner. The answer is B. Next question. Everyone, I require 5 lakh rupees after 5 years. How much I should invest at the end of the year? End of the year, matlab every year I am putting some money. है ना? If the rate of interest of compounding is 10%, then what would be the amount? Then what is the amount required? How much I should invest? Everybody, after 5 years, I want 5 lakh rupees. Every end of the year, 1, 2, 3, 4, 5. I am submitting money, I am depositing money by the end of every year. Is this uniformity? Yeah, that is uniform. I am paying money every year. Isn't it annuity? And which kind of annuity is it? Ordinary annuity or annuity due? Quickly. Is it ordinary annuity or annuity due, everyone? It is annuity, that is ordinary. When you put at the end of the year in something, it is ordinary annuity. If you put every year, then it is annuity due. That is called annuity due. So calculate the value. The formula for annuity due is P1 plus R raised to power n minus 1 divided by R. So calculate the answer there. What would be the calculation? Nahin, due is basically something which is done at the beginning of the year, sir. That is why this year is also due. That is why the name is due itself, because we are putting the money in the year beginning. So by the end of the year, we have this year interest. Then the next year, I'll be having interest on interest with this year as well. Ordinary annuity is like being always late. So you are late here, and then in this year, no interest. Next year, you will start getting the interest. So what would be the answer in this case? Can we calculate it? It is 5 lakhs, 1 plus 10% divided by rate. What is the rate? 10% na? Divided by 10% raised to power n bhi tha no? Minus 1. It is for 5 years. So this is going to be 1 plus 10% raised to power 5 minus 1 divided by 10%, and we have 5 lakhs above. Acha nahi, this is what we are getting. There's one more point in this area. This is the future value. This is the future value. This is what they want. This is the amount that we are getting after 5 years. This is actually a question which is twisted. After 5 years, I want 5 lakh. What amount I should put every single year? This is basically something I will have to reverse. Look at this again. The formula says your future value. In terms of ordinary annuity, your future value is equal to present 1 plus R raised to power n minus 1 upon R. In terms of annuity due, there would be one more 1 plus R, because you have got interest of one more year in it. So in this case, since it's not there, we are not considering it. In this case, we are given this 5 lakh rupees. We are given this 5 lakh rupees. Principal is not known to us. Can we calculate it? 1 plus 10% raised to power 5 minus 1 divided by 1 plus 10%. Sorry, it is 10% only. Now when you calculated this, 10% will go there, 1 plus 10% raised to power 5 minus 1 will be solved, and it will come here, and then you will get your answer. The confusing part of this question is just that this is your future value. This is not the amount that you are putting in right now. This is something you will receive in future. After the entire calculation, you will get the value of 81,967. Done? Very minute lines to be covered. Specifically in terms of module C, this happens. Every time you are doing a question, you have to check and recheck to make sure that you are going correct. Because there are different words, then the amounts are really crazy as well. So that makes the entire question that you have to pay extra attention to it. I've given the particular formula for annuity as well. This is the formula for ordinary annuity. P 1 plus R raised to power n minus 1 divided by R. If this is for ordinary annuity, if the question asks regarding the area of annuity due as well, for annuity due, it is P 1 plus R raised to power n minus 1 divided by R, and here you have 1 plus R, one more, because you have invested the money in the beginning of the year and you have got 1 plus R more. Okay? So in this case, that would be the answer. Another question. A sum of 25,000 is borrowed over 8 years. Okay, we have got it for 8 years. What will be the monthly repayment at the rate of 18% compounded monthly? The problem is compounding is done monthly. The same method is used in the area of EMI. Look at the question, everyone. How would we do this? The formula for SI is very similar to that of, that reminds me of SI there, P into R. But here we do not have T. What we use is 1 plus R raised to power n, and we also have 1 plus R raised to power n minus 1 here. So in this case, first of all, 25,000 is your principal, then your time period, n is your 8, and once we have this 18%, now the point is 18% is for the entire year. So you have to divide this particular portion by this 18 should be divided by 12, giving you the effective rate. Along with this, 8 should also be multiplied by 12 so that you get the number of months for EMI. EMI questions are one of the, I would say, longest questions that are there in terms of calculations. So in this case, what will we do? Let's calculate it together. It turns out to be, this is 25,000 multiplied by, rate is what then? 18% is something that we are specifying there. 1.5, but this is in percent. So it turns out to be, the percentage is basically 0.015. And then we have 1 plus 0.015 raised to power. In this, we will take it as, we will have to take it as 96. Oh. है ना? That would be 96 divided by 1 plus 0.015 raised to power 96. As in the entire period, the total number of investments would be 96. When you have to solve these questions, what you can do is, when you have to make the calculations, how can I go up to 1 raised to power 96? I have to click on equal to 95 times. Do we have that much amount of time in the examination? No. So what you can do is, you can use these factors. What you can do is, you can take up 1.0015, take up in your calculator 1.0, there are It is actually 1.015 raised to power 96. You can take these two factors. First of all, take 1.015 on your calculator and do it for 8 times. That means you will have to click on multiply. Then you will have to click on equal to, but 1 less than 8. That means click on equal to 7 times. Now, whatever answer comes, you will have the particular portion where 8 is done. Then click on multiply again. Whatever, then click on equal to again. What you are getting here, then do the same process with 12 times. That means instead of doing it 96 times, you have divided into two factors, 8 and 12. First of all, you do it, calculate it for 8. Then whatever answer you get, you click on multiply again and you do it for 12 times. 12 times means clicking on multiply and doing it equal to for 11 times. You will get the same answer. Sometimes if it goes up to very high amounts, you don't have to calculate it that way. Just divide it into two different factors and then calculate it. Or if the number is very high, sometimes they can give you in the hint section as well. This is the formula for EMI. Principal amount plus interest on loan. This is what we pay. P into R into T, that is P into R into 1 plus R raised to power N, divided by 1 plus R raised to power N minus 1. These questions are required to be done very carefully. It will turn out to be 493 rupees. Okay? All the calculation is given there. First of all, 8 into 12 is 96, that's why. And 18% is basically 0.015 monthly. This particular question, after the completion of the class, right now you will be all jam-packed. If you are actually doing these questions, what you can do is, after the completion of this particular class, go through it again. Solve it. And not only look at it, solve it in your calculator, write it down and do such questions, because the practice is definitely required. If you don't do the practice portion properly, you will never be able to grow. Right? Next question. Compound interest is paid on which of the following? Principal, interest, principal amount and interest already accrued, or principal amount and interest to accrue. CI is paid on what, everyone? Compound interest to be paid. Very good, Hari Krishna sir. In this case, the correct answer is actually C. Because first of all, I put my principal into something. Next year, I get principal plus interest. Now this is reinvested. The next year, I will get interest on these. And then this will be again reinvested. That is why in compounding, we get more returns as compared to simple interest. Next question, that is again regarding EMI, everyone. The loan is of rupees 1 lakh at an interest rate of 12% per annum to be repaid in 12 months. EMI will be, it will be repaid in 12 months. P into R into 1 plus R raised to power N, 1 plus R raised to power N minus 1. But in this question, whenever you are doing such questions, 1 lakh multiplied by 12%, that means it is 1%. Multiplied by 0.01, multiplied by 1 plus 0.01, raised to power how many months? Repaid in 12. So this is 12 months, divided by 1 plus 0.01, raised to power 12 minus 1. You just have to do the calculation of 12 only once. Done, everyone? Done, everyone? The answer to this question will turn out to be 888.5. 1.01 multiplied by 0.01, we will have to calculate 1.01 is raised to power 12. Calculate this portion and then you will get the answer. Rate is 12% per annum, sir. If it is for per annum, divide it by 12. You have to divide it by 12 first so that you can get the answer there. Nahi, sir. Yes, sir. It is basically 0.12, but this is for per annum, na? Divided by 12 as well. It is for the entire year. You want to calculate it only for 1 month. Yes, sir. Very good, sir. It is 888.5. Since these kind of questions require a lot of time, and at the same time, you need a little time to calculate things as well. That's why I wanted to keep it today, so that you have enough time to focus upon the other ones. Next question. Under which of the following situations the decision outcome on evaluation of inventory opportunity vary under NPV and IRR? NPV and IRR are both modern ways in terms of techniques. Okay? So which one are they talking about? Time disparity, cost disparity, life disparity, or volume disparity? Under which of the following situations the decision outcome on evaluation of investment opportunity vary under NPV and IRR methods? The decision outcome, time disparity, or I think if I would say in all the areas or any specific A, D and B, A, B and C, or only D, or B, C and D. There is nothing related with volume there. Time, cost and life is something that I've seen, right? So I would go with C. Time problem is there. Then when we talk about this area in terms of NPV and IRR, NPV is when we have it as positive. If the future returns are more than what I've invested, then it is worth an investment. IRR says, I don't know what discounting factor should I use. Let's try something. So in this case, they will be trying that point. Okay? Both NPV and IRR techniques used to evaluate long-term business proposals. NPV is the difference between discounted cash flows and discounted cash outflows. On the other hand, IRR is a rate at which NPV is equal to 0. Okay, next question. If you wish to grow 17,000 over 5 years so that you can replace your car, what monthly deposit would be required if you want to invest it at 12% compounded monthly? Similar point. Everyone? What would be the answer in this case? This is actually a part of sinking fund, I would say, when you are putting annuity there. But now the same formula for annuity can be used here as well. In terms of this amount, we can use the same formula. Amount is equal to principal 1 plus R raised to power n minus 1 divided by R. But this has to be done compounded annually, 12% monthly. Then we have to divide it by 12 as well. So this is going to make it a little lengthier. 12 divided by 12, that will give us 0.01%, and we have got 5 years. So multiply 5 into 12, that gives you 60. Done? There would be proper application of this particular formula. So go ahead and answer. 279, 392, 208 or 272. What would be the answer? Let me show you how to calculate it as well. Our principal is of 17,000. 1 plus, we have to add 0.01 raised to power 60. Again, use the same factors. Do it 5 times and then 12 times. Divided by your rate. Rate is 0.01. Done? In this case, the answer will come out to be 208. How do we calculate it? Same method. The formula is stated here. But they have just used, there is one more point. We are getting the amount in future now. This is basically if you want to grow. Same mistake I made here as well. They were asking about this amount is to be grown. Again 17,000. This amount is to grow to 17,000. In future, it's going to be 17,000. What is the present amount that I should invest? This is the purpose of sinking fund as well. This is sinking fund. When we talk about sinking fund, since I want a car after 10 years, so for 10 years, I will be saving a specific amount so that it becomes 10 lakhs again, and I can buy the car of 10 lakhs after 10 years. So I don't have to take out a lot of money together at that point of time. Every year I'm going to invest this money, and from this money I will grow a future amount. That is why sinking fund has been used, because sinking fund is a method in which you don't take out a lot of money at once, right? You take out a little money every single year, and the same money is invested in the market. From that you earn a lot of money. Once you earn a lot of money, what will happen is you will make it as an investment in the market. Once just about to pay off do the same. That means you have to purchase something after 10 years. Then what you will do is you'll sell off the investment. You will make profit and put it back into the market. So that now you have got the money. You don't have to take a lot of stress in one particular day regarding taking out a lot of money from the business to make sure that you have the money. Okay. This question relates to the area of swaps. Let's see. This is actually in the derivatives. This is a question of derivatives. Let's look at this, because in the question I can see where the cash flows on both the legs of the swap are reference to different floating rates. Swaps can be used to create either synthetic, fixed or floating rate liabilities or assets to hedge against adverse movements, to reduce the funding cost by exploiting the comparative advantage that each counterparty has in the fixed and floating markets. The above refers to. This is basically to the swaps. One thing is clear. But what kind of swaps are they talking about? Are they talking about options? Are they talking about futures? Are they talking about interest rate, or are they talking about basis swaps? These swaps are basically that can be used in fixed as well as floating area. They can actually be hedged as well. Hedging is basically done when the particular organization is too much scared that what will happen. So they have one transaction here and they have a similar transaction somewhere else as well, to make sure that the particular loss is basically set off somewhere. It is not going from our pocket. Done? The answer is basis swaps. The answer for this answer is basis swaps. The entire definition is of basis swaps, directly taken from the book. Such kind of questions can also be made. You have to identify the characteristics. Interest rate swaps are basically, sir, you have got, you are having fixed rate in terms of your loan. I have got floating rate. We don't like what we have. So in this case, your principal is your problem. My principal is my problem. But you will take up floating rate. I will take up fixed rate. This is interest rate swaps. We are just swapping the principal. We are just swapping the interests. We are doing nothing else. We are just swapping the interest. You pay my interest. I'll pay your interest. That is called interest rate swaps. And this is something which clients cannot do on their own. So the banks keep on identifying such people who are looking forward towards these swaps, and bank also takes a commission out of it. That's how banks earn. That is why now we say the banks are not earning only from depositing money and getting the money. They are growing from other areas as well. Acha, next question. Call option is a contract which the buyer has the right but not the obligation to buy or sell specified quantity of the underlying assets. I'm sorry. Next is the right but not the obligation to buy specified quantity of the underlying assets. The right but not the obligation to sell the specified quantity of the underlying assets. The obligation to buy or sell a specified quantity of the underlying assets. Call option. Hint, call option is basically related to the company. It is true, it is actually a right, not an obligation. So, elimination. Last one is out. What would be the point there? In this case, you have the right, but not an obligation. You don't compulsorily have to do this. To buy a specified, in this case, you can buy the specified quantity. In case of put, you can sell. Okay? Call and put options. There are two kinds of options there. Na? So then this is the point. The right but not an obligation to buy specified quantity on the underlying assets. Okay, next question. Dash is the simplest form of interest swaps where the interest rate, fixed rate is exchanged for a floating rate or vice versa on a given notional principal at a pre-agreed intervals during the lifetime of the contract. Options, then plain vanilla swaps, interest rate swaps or basis swaps. These are basically simplest form of interest rate swaps. It is a form of interest rate swaps. That means I might have to keep this out. Where the fixed rate is exchanged for a floating rate. We have just talked about it. That means this is interest rate swaps, but this is basically going precise in it. Notional principal on a given notional principal during the lifetime. In actual under interest rate swaps, they have given plain vanilla. This is the name of these kind of swaps. Definition directly taken from the book there. That is plain vanilla swaps. Okay? Next question. In certainty equivalent approach, adjusted cash flows discounted at. See, I know in the future I'm going to receive 10,000, 15,000, 20,000, whatever the amount is. Then what we are using, adjusted cash flows are discounted at accounting rate of return, hurdle rate, risk-free rate or internal rate of return. In case of certainty, once you know about the certainty there, in this case, the answer would be risk-free rate. There is a certainty. That means if there is no risk involved, it would be the risk-free rate. Okay? Next question. Which of the following is true with reference to capital budgeting? Capital budgeting is related to the asset replacement decisions. Cost of capital is equal to minimum required return. Timing of cash flows is relevant. What would be the point which is in reference to capital budgeting? In terms of capital budgeting, is it only 1 and 2, 1 and 3, 2 and 3 or 1, 2 and 3? What would be the answer in this case, everyone? Please go ahead and answer quickly. Capital budgeting is related to asset replacement decision. I doubt that. It is way bigger than this. Rest two are still correct. Cost of capital is the minimum required rate. This is the one that I've been looking forward to. Rajiv sir, the best part is if you go through all the books now, in all the specific areas, we are covering similar concepts. That means if you actually go through the concepts in a proper way, now, all the subjects are interconnected. है ना? So in this case, the correct answer will come out to be 2 and 3. Okay, this is a completely accounting area question. Similarity of syllabus is definitely there. 0 coupon bonds. Bonds, everyone. The bonds do not carry any interest. It is issued at a lower price than the redemption value, or carry a fixed rate of interest payable at the time of redemption, bears 0 risk, or all of the above. There can never be a 0 risk. That sounds really weird. This doesn't happen. Then if this is wrong, this is also gone. It has no fixed rate of interest. There are bonds which have fixed rate of interest. In this case, there are none. In this case, what is going to happen is they do not carry any interest. They are issued at a price, say it will be issued at 90 and paid at 100. So the answer would be they do not carry any interest. Next point. An asset cost is 16 lakh, has a residual value of 1 lakh and is expected to last 5 years. Acha, in the last class, many of the bankers were asking, ma'am, can we do some question regarding sum of digits method? So I brought one particular question on sum of digits method as well. So no doubt this is a part of module A. So just a question of module A is there. Sum of digits method. Under sum of digits method, what do we use? First of all, it is for 5 years. So let's add up 1 plus 2 plus 3 plus 4 plus 5. This is total is 15. This is the sum of digits. The asset cost is 16 lakh. Residual value is 1 lakh. It will be 16 lakhs minus 1 lakh. That gives us 15 lakh. Now on this 15 lakh multiplied by, which year are we talking about? Calculate the depreciation for the second year. We have to calculate the depreciation only for the second year. So multiplied by 2 and divided by 15. Now calculate the value, everyone. Multiplied by 2 and divided by 15. $15 lakh multiplied by 2 divided by 15. 2 lakh. Done? In this case, I've given all. Acha, how many years are left? There is one mistake. In this case, this point is actually number of years left. This doesn't has to be 2. In the second year, it actually goes opposite. In the first year, 5 years are left, 4 years are left, 3 years, 2 years and 1 year. We talk about it in the beginning of every year. That means this is in the beginning of the 5th year, in the beginning of the 4th year, in the beginning of the 3rd year. In this case, it is going to be 4 divided by 15. For the second year, we will use 4 instead of 2. Because how many years are left? We have just entered the second year. Then the entire second year, 3rd year, 4th year and 5th year. 4 years are left. So in this case, it is going to be 15 lakh multiplied by 4 divided by 15. So in this case, this would be the point. That is why we have given 5, 4, 3, 2, 1. Sum of digit methods says that number of years left. The formula goes like your residual value multiplied by, divided by sum of digits multiplied by number of years left. How to remember number of years left? That is in the beginning. Start from the beginning. In the first year, we are left with 5 years. In the second year, we are left with 4. And that goes like that only. Okay? So all the calculations are given. 5, 4, 3, 2 and 1. The answer is D. Cost minus residual value. This is the depreciable value. This is called, acha, this is also wrong. This is actually if I have to calculate the actual formula, they call it depreciable value. Whatever your depreciation value is. That means if we have got a total of 16 lakh, remove the depreciation part, whatever is left. Depreciable value multiplied by number of years divided by sum of digits. I'm sorry. Next question. Payback period in which an expected cash flows are discounted with the help of project cost of capital is classified as discounted payback, discounted rate of return, discounted cash flows, or discounted project cost. In the area of capital budgeting, they have got roughly got 2 types. One is called traditional and one is called the modern techniques. In the traditional, they had 2, actually 3, but in the book we have 2. Payback period and accounting rate of return. In the modern, we have got NPV, net present value, IRR. In the book, somewhere in a few areas, they also cover MIRR, modified in internal rate of return. Then we have profitability index. Okay? And if in the payback period, that means in how many years we are going to cover the money. And if in the payback period, you are also given the point where that is, they are also using time value of money in it. That is discounting. That is called discounted payback. Okay? So in this case, all these points would be there. Discounted payback period. Okay, here comes the question related to the Forex, everyone. I think we would end it here. Okay? 1.5 hours we've gone till now. So in tomorrow's class again, I will continue with all these topics further. In the rates of Mumbai market are US dollar 1. Rates in London market is this. We will get US dollar for 78.8545 and for, there is 1 point there. And for 1 US dollar, we will get 0.9027. Now the point is, this is rupees. Let's talk about it. 1 US dollar, if we want to buy, we can basically look over towards the fact now, we always follow the point where buy low and sell high. That's the particular area of Forex. In this case, I wanted to move from rupee to euro. But the point was, there was no direct rate given. So I had to use a dollar. So what I'll do is, first of all, I will buy dollar and then I'll sell dollar. So basically, first of all, I'll sell dollar and then I will buy a euro. In this case, everybody, if a question goes like this, 1 US dollar is equal to 74.8450/545. This is basically the buying and this is the selling rate. Okay? Then 1 US dollar is equal to, this is rupees, and 1 US dollar is equal to euro 0.9027. If your LHS are same, if your LHS are same, then as per the chain rule, always divide. But which one would you divide? 74.8450 or you will divide 74.548545. Since in this case you will sell dollar and then buy euro, because we do not want dollar, I want euro. So what will I do? I will sell the dollar and then buy euro. So in this case it is going to be 74.8545 divided by 0.9027. What is the value, everyone? What is the value? In this case, it will come out to be B, 82.92. This is a portion of Forex, a question directly converted into the MCQ format. This kind of question can come in the examination. This is chain rule, everyone. Chaliye, that's it for the day. This is where I would end up my session, since in the evening we'll be having our marathon as well. That would be at 6 p.m. It's going to be a hectic day for you, right? So whatever topics are left, I'll be covering it in a marathon tomorrow as well. That would be again a mini marathon. I would be covering another set of questions with you so that you can prepare properly. So all the very best for your examinations, and keep on working hard, everyone. Every single effort that you are putting is definitely something which is going to pay you off in the examination. All you need to do is you need to be very calm and composed when it comes to your preparation, right? So that's it for the day, everyone. Thank you so much. I'll be meeting you in the next session. That is, I'll be meeting you tomorrow. Along with that, the marathon week is going on. So every evening we are coming with one or the other marathon. So stay tuned and keep an eye on our official YouTube channel. That is Officers Adda 24/7. So I'll be meeting you in the next class tomorrow. Yes, Naresh sir, we have the paid class as well. Kindly review the account regarding the same. You'll be able to find it. All the paid bankers, just review the particular area of your account right away. Just after we are done with this, you will be able to know about the timing as well. I believe you didn't get a notification or something, or that can be the point, sir. It's way better that always check the account. Right? Chaliye. Thank you. We'll be meeting tomorrow. Bye-bye, everyone. And acha, I have my morning session as well. So I am meeting you in the morning. I today had a session with you. Along with that, I am conducting the class in the evening as well. So I'm going to meet you till the time the examination is there. So keep on working hard, everyone. I'll be meeting you soon. Thank you.